Welcome to Gold Silver Pros.
Hey guys, this is Rob with 𝘎𝙏𝙊𝙍𝙍𝙀, and it is Tuesday, April 9th, 2024. A lot to talk about. This is going to be largely a story-driven broadcast for the weekly market wrap-up. Lots of stories to talk about, some exciting things to talk about gold and silver. One of the stories, or a couple of stories about gold and silver specifically, a lot of it's about the economy and some economic data. Well, let's just jump right into it. As I look at the economic data first, I wanted to go over what's basically going on. I look at the economic calendar and pull, certain statistics and kind of cover those every week in the broadcast. Then I'll move on to some stories, and then I do gold and silver. For those of you who are new to the program, this is sort of my catch-all newsy sort of broadcast during the week in which I talk about all the stuff that's sort of happening. And I end up with the gold and silver review. It's what's going on specifically in that market. So as we look at what was going on last week, we had a nice little print in the S&P U.S. Manufacturing PMI, Purchasing Managers Index, meaning what are purchasing managers seeing and how do they feel about the economy based on what they're purchasing for their manufacturing businesses. We had a print of 51.9, which is positive. Anything 50 or above, well, 50 is neutral. Above 50 is considered positive. Below 50 is considered negative. And for 2 straight months, it's been positive overall for U.S. manufacturing. Even though some of the regional indexes aren't doing well, overall manufacturing's okay. Now, manufacturing is not the bulk of the economy, so it doesn't really mean a ton with regards to an increase in the GDP, but it's nice to see that we're still making something, and then we haven't totally cratered because manufacturing has been taken on the chin here for the last few months, big time. Construction spending as a part of manufacturing or making stuff is actually down 0.3%. It was down 0.2% last month. And so construction is down. Now that includes everything, not just residential houses. It could be any sort of construction. It could be shipbuilding. It could be homes. It could be commercial. It could be anything. And it's down a little bit, which is in line with what we've been seeing in construction the last few months. The ISM manufacturing survey is at 50.3%. Again, slightly positive. It's up from last month at 47.8. So in the last month, we made just a smidgen more than what we made last month, but it's not enough really to write home about. But I wanted to talk about it because, hey, every once in a while, it's good that we have something that's not totally cratering at the same time. Factory orders are up 1.4%. That's good. It means that feeds into what we're making. On to the jobs front. We had a mixed bag from the jobs report last week. Job openings, the U.S. government claims are at 8.8 million, which is literally the exact same number as next month, which I'm kind of skeptical about, but it is what it is. ADP and the non-farm payrolls both come out the first week of the month. ADP puts their print first. They're the private payroll reporting company that does a lot of that payroll stuff. And so they do their own reporting about what's going on in the economy from a private payroll perspective. And then you have the non-farm payrolls, which is the government's report, which tends to be maybe a little bit broader in its methodology, but I think less exact in its methodology. So let's go through those two. And the ADP employment, they saw an increase of 184,000 jobs, which was an increase from last month of 155,000. So that was positive. The non-farm payrolls came in at 303,000, which just seemed very positive. However, when you dive down into the details of the non-farm payrolls, almost all of them were part-time jobs. A lot of them are going to non-qualified workers or what we call illegal workers. And statistics have shown the last few months that I've been looking at that a lot of the jobs are going part-time, actually not last few months, I'd say last half year to a year, that the jobs are going more part-time, and a lot of them are going to non-citizens, people who have not established citizenship because they have lower labor costs. So as the economy starts to tighten up, more employers are moving to cheaper labor, and they're moving to part-time jobs to try to control their costs and their overall expenditure. And those are going basically to, not to people who have been here for a long time that are hurting for full-time jobs, that have lost their full-time jobs, let's put it that way. The U.S. unemployment rate actually dropped a bit to 3.8%. I never follow this number because it's the most misunderstood number in all of government reporting. I think it's total balderdash, but in any case, that's what the print was. Wages were up 0.3%. Now, they're not really still keeping up with inflation, but that's closer to inflation than it's been recently. So we did see a nice jump overall in wages last month, but it's a drop in the bucket compared to the gap between how wages have been rising with relation to inflation. Prices are still rising faster than wages, although wages caught up just a bit last month. It's not enough really to make up this giant chasm that we've seen, however, the last 20 to 30 years. All right, moving over to Small Business Optimism Index. This is put out by the NFIB. And quote here from their website, nfib.com. The NFIB Small Business Optimism Index decreased by 0.9 of a point in March to 88.5, the lowest level since December 2012. This is the 27th consecutive month below the 50-year average of 98, and it's the lowest in 12 years. Think about that. The net percent of owners raising average selling prices rose 7 points from February to a net 28% seasonally adjusted. Quote from the article, small business optimism has reached the lowest level since 2012 as owners continue to manage numerous economic headwinds, said NFIB Chief Economist Bill Dunkelberg. Inflation has once again been reported as the top business problem on Main Street, and the labor market has eased only slightly. Exactly what we just said in reading out the data to you. Key findings from the NFIB survey include the net percent of owners who expect real sales to be higher decreased 8 points from February to a net negative 18%. 25% of owners reported that inflation was their single most important problem in operating their business, up 2 points from February. Being a small business owner myself, I see that every day. Everything's rising, but our revenues aren't necessarily rising along with it. All right, back to the article. Owners' plans to fill open positions continue to slow, with a seasonally adjusted net 11% planning to create new jobs in the next 3 months, down 1 point from February and lowest since May of 2020. That would be the shutdowns. That's astounding, by the way. Seasonally adjusted, a net 38% reported raising compensation, up 3 points from February's lowest reading since May of 2021. On to the next story. Margin debt surges as bulls leverage bets. Actually, we're going to get to that right before we get to the gold report. Don't worry about that, guys. We're going to go on to the next one. I want to talk about the state of the economy in terms of dollar stores, 99-cent store and dollar store. Listen to these two stories. According to ABC7 Eyewitness News Twitter, quote, 99 cents only store to close all stores and wind down its business operations, company announces. You have a dollar store going out of business. Why? Well, let's go to a companion story from Dallas Tree shoppers, a revolt over $7 prices on Zero Hedge. Discount retailer Dollar Tree, this is from the article, has sparked a revolt among some of its customers after increasing the price cap of items to $7 across thousands of stores nationwide. Quote, if it were really going to go up like $7, that'd be too much. I'd rather just get everything at Walmart, said Scott Kolak, a Dollar Tree regular, told WPTV West Palm Beach Television News. Quote from the story, on March 13th, Dollar Tree CEO Rick Dreiling told investors during a conference call, this year across 3,000 stores, we expect to expand our multi-price assortment by over 300 items at price points ranging from $1.50 to $7. Dreiling said the higher cost would include food, pet, and personal care items, though not all items will reach the $7 mark, obviously. Quote, over time, you also see us fully integrate multi-price merchandise more into our stores. Store shoppers will find $5 bags of dog food next to our traditional $1.25 pet treats and toys. And our $3 bags of candy will be found in the candy aisle, Dreiling said. Dollar Tree CEO also pointed out that the company's fastest growing demographic is consumers making around $125,000 a year. Quote from the article, this comes as Bidenomics fails what's left of the middle class. Think about that for a minute. 99-cent stores can't keep stuff priced around $1 and they're going out of business. Dollar Tree raises their prices to anywhere from between $5 to $7 or $3 to $7. And that's the only way they can stay in business. And people are saying, I don't want to go there. I want to go to Walmart. Well, I'm going to clue you in. Walmart's not going to be any cheaper, probably on most products, than a Dollar Tree or a dollar store. And the funny thing is, the most impactful part of the story from Dollar Tree is the quote that most of their new customers make $125,000. Why do you need, if you make $125,000 solidly into six figures, do you need to go to dollar store? Because inflation. This is reaching the upper middle class. Inflation is killing people. All right, we're going to get into the share for the rest of these stories, and we're going to talk about what else is going on in the economy. And some of this stuff's going to astound you. We're going to go to oil price here real quick as we share screen and get over to that window. Here's an article on Russia preparing for a potential gasoline shortage. Why? Because the bombings have taken out a lot of their infrastructure, the drone attacks from Ukraine. It says here on oilprice.com, quote, Russia is seeking to import gasoline from Kazakhstan in case shortages occur on the Russian market because of the diminished refining capacity due to maintenance and damages from Ukrainian drone attacks. Reuters reported on Monday, citing industry sources. Russia has asked Kazakhstan to prepare to potentially deliver 100,000 tons of gasoline, the sources told Reuters. Ladies and gentlemen, that's not an insignificant amount. My goodness. Russia is also ready to import gasoline from Belarus if the current domestic supply is insufficient to meet demand. Russia estimated to have slashed in half its gasoline exports via railway after imposing a 6-month ban on exports from March 1st to ensure sufficient domestic supply in peak demand season, while several refineries are undergoing regular maintenance and urgent repairs after Ukrainian drone strikes. What's that going to do to the rest of the oil and gas market across the world? Because if they have to import it, and Russia is one of the largest refiners and producers of oil in the world, which they are, and they have to import it because of the drone strikes and other things, how's that going to affect the overall supply of gasoline oil to the rest of the world? Ladies and gentlemen, can you say higher prices are coming to American gas pumps? Because yes, they are. And that's what that story tells you. That's why we read it on the program. All right, the story I referred to earlier that I want to get to now. I love realinvestmentadvice.com because they put out great charts. And this one's talking about margin debt. Now we're talking about margin debt on the market, not in gold and silver, but just in the market in general, mostly stocks and things like that. And there are a couple of charts that I want to point out to you. This is the one right here that I want to point out. This is the market greed fear index. They're on extreme greed. What does that mean? It means people are selling the boat. They're borrowing money to invest on margin because greed, baby, because the stock market's been going up so long that people believe it can never crash. It will never crash. Sell everything and borrow as much money as you can and go all in, baby. It's never going to crash. And what happens when that usually gets to that point? Well, it crashes. Look at this second chart, margin debt versus the S&P 500. It's very interesting to note that the use of margin, the use of borrowed money, which you don't own, but you are liable to pay back out of your account, versus the S&P 500 is almost identical. So as the S&P 500 is rising, what this chart means is people at this point in time take the most risk. So when the stock markets do the best, people are the most levered and take the most risk. And what happens after you reach all-time highs in the stock market after a really long bull cycle? There's a correction. Who's going to be the first to get slammed in the correction? It would be the people borrowing money to get into this massive bubble. This is the best chart in here, however, because this looks at free cash balances versus the S&P 500. The blue areas of the chart are where investors have positive free cash. Notice that since January of 80 to now, about 90% of the time, investors haven't had free cash. They've been investing in the market and borrowing on margin. This is the negative free cash. You go negative free cash when you're on margin or you're borrowing to get into the market. Look at what happens when you reach a periodic peak in negative free cash, or in other words, borrowing on margin to get into a speculative investment like the stock market. Well, right around here in 2000, we had the tech crash. We had a massive crash in the market, and then eventually went to free cash. Massive crash here in January 2008. Look at the amount of negative cash or borrowed money compared to all the way back to January 1980, 45 or 44 years. We're at the most borrowed cash in the last 45 years in the markets. What do you think the crash is going to look like this time, and how many people are going to get destroyed when the market rolls over this time in stocks? It's going to be a literal blood bath. Blood bath. You're going to hear stories of people jumping off bridges when this baby breaks. Trust me on that one. All right, another one is a quote from Twitter that I wanted to put up. Peter Spina of GoldSeek was replying to breaking market news that JP Morgan CEO Dimon on the debt ceiling. Quote, "As long as I'm alive, the U.S. will not default." My response was, well, how do you have control of that situation? Are you admitting basically that JP Morgan, along with a lot of private banks, own the Fed, which we all know, that's how it's created. The average person doesn't know that. But is Dimon both one telling or speaking the quiet part out loud that the Fed is not a government agency. It's not federal. It has no reserves. But the Federal Reserve is private, known by the banks. And he would be able to make such a statement because I don't know, he may be a voting member of one of the banks that actually owns the stock of the Fed, which is privately owned by the commercial banking system. We believe that's how it was created. And two, is he basically forecasting what America is going to do? because as the debt begins to default, the only way to stop the defaults to print their way out. This is just confirmation. They're going to print their way out, period. You're going to have hyperinflation, period, in story. That's why I thought that that was so interesting. Now, this is something making big waves in the gold circle. The rest of the program is going to be mostly about gold and silver, and then I'll do a summary at the end. According to Yahoo Finance, China's latest investment frenzy sparks wild swings in the gold ETF. And from Bloomberg, quote, an exchange-traded fund that owns gold companies has become the largest target of frenzy trading in China as investors pile into corners of the market seen as resilient to the country's economic challenges. What were we talking about the last 2 years with China? Breaking up and crashing of the real estate market, problems in their stock market, overvaluations. People are panicking in China and they're going to what? Gold. This is one of the largest countries in the world in terms of people and investment. The second largest economy in the world, one of the most populous countries in the world. And what are they going to as they experience economic problems? Gold. What's the rest of the world going to go to as you experience economic problems? Gold. All right, another quote from the story. Quote, trading for the China AMC CSI Gold Industry Equity ETF was halted until 10:30 a.m. Monday, this is yesterday, in order to protect investors' interests, China Asset Management Co. said in a statement Monday. It was the second trading suspension for the product since last Tuesday. What do you mean investor interest? You mean people that may have had a short position, or the ETF maybe not had the gold, or something, you know, with the equities in there, you know, who are they protecting? If the market goes up, the market goes up. The government's intervening to protect someone. My question is exactly who? I'm going to leave that as a mystery for you guys to figure out. The decision came, quote from the article, after the fund's premium over its underlying assets increased to more than 30% as of April 3rd, the highest on record, Bloomberg compiled data shows. The ETF's price had gained over 40% in the past 4 sessions. 40% in 4 days before falling 10% after trading resumed Monday. The ETF fervor is a fresh example of yield-hungry Chinese investors flocking to pockets of market strength as deepening property woes, volatile stocks, and falling deposit rates at the banks reduce their options. The enthusiasm about products tied to gold, which has staged a record-setting rally in recent weeks, also shows a desire to park money in a sector seeing relatively immune to a struggling economy. Quote, gold is trading at an all-time high, and gold ETF demand has surged in the past week with almost 600 million of net inflows into gold ETFs globally, said Rebecca Sin, a Bloomberg intelligence analyst. Demand in mainland China could continue as investors look to diversify their holdings with commodities and foreign ETFs. Well, I got another fund for you, Chinese Southern Shanghai Gold ETF. Now, this is a specific part of the country for a specific set of equities, but it's gone nuts. Look at the chart. It's going nuts everywhere in China. Look at the increase since March. From March to April, this index has increased from 4.7 to 5.6. That's a huge change. And this is just another ETF where you can get access to gold and gold equities in the industry space, more specific to Southern Shanghai, which, by the way, Shanghai has one of the largest physically traded gold exchanges in the world. So lots of interest in what's going on in the gold and silver market over there in China. Why? Economic problems. You saw it from the article as reported by Yahoo and Bloomberg. Not hard to figure out there. All right, on to gold and silver. This is the part where we look at all the charts for gold and silver, and I kind of explain how the market works, and I give you an idea of who's shorting and who's going long and all that kind of stuff, because that kind of tells you, it does tell you how the spot price determines who the major players are. So we're going to do that now. So this is gold open interest. I'm going to read the top line here. It's this line right here that I'm highlighting right here at the top. You can see in the latest data, there were 989,000 contracts open. The total volume of trades was 301,670 contracts. Deliveries were only 267, so that's less than 0.1% of all the volume for that day, which would be Monday's data. As we look at the ticker tape, were actual delivered. So again, 99.9 something percent of contracts on the market are not physically traded. So it has bupkis to do with the physical price discovery. That's yield, which was, if you watched last Thursday video, I talked about the difference between spot and premium or yield. Go watch that video. I spent 50 minutes explaining that in a lot of detail. Also to note, the EFPs or exchange for physicals were at $35.99. Now, in gold, we've seen exchange for physicals play a huge role in people attempting to either get better prices in the UK or to get physical deliveries outside the COMEX, because this month trading right now is not a huge delivery month. If we look at April, it basically only has, what is that, 267 deliveries and only 202 more contracts left. You're not going to get a lot of gold out in April. It's a futures market, and June is where everybody's trading. That is 424,763 contracts. So you can't get a lot of physical exposure on this month because only 6 months are really hugely deliverable on the COMEX for either gold or silver. And so what do? They use the EFP, which is taking a COMEX futures contract and trying to pull it over to the UK market and saying, can I get my gold over there, please? And so there's a bunch that go over there. Now, the last few years, EFPs have exploded because there's an arbitrage opportunity. And what do I mean by that? Prices in America are lower than just about everywhere else. So what you do is you buy a contract over here and you try to go get it over there, or you buy a contract here and try to stand for delivery. And if you can't get it, you go over there. That's what they're doing. That's why EFPs are so important. Well, if we look at Friday's data, we had 4,719 EFPs. And if we look at Thursday's data, we had 2,262. So a lot of trade hunting for gold across the world from west as you move further east. And of course, one of the largest or heaviest physical delivery markets in the world is China's Shanghai, where I believe they're delivering almost 80% gold and almost 30% silver on those contracts as compared to less than 1% on COMEX. And we're going to look at settlements just to show you price, just to prove the point. This is where price is determined. You can see the change and the average settled price for the day. And so this is, I believe, Monday's data. We were up $5.60 on gold on the big June contract with 285,000. You can see highlighted here. Change column right here. This column up $5.60. You can see right here. This is where spot prices are determined in the US. It's very close to the spot price quoted. If you want to know how spot price is determined, go to my detailed video this past Thursday titled The Truth About Gold and Silver Spot Price and Premium, and I explain it. Go back a day and it was up 36 bucks. That shows you right there how price is determined. On to silver, looking at the volume, we have elevated volume, and I'm going to show you why we have elevated volume in a moment. Most of the time it's selling. There's actually a bit of buying here, but elevated volume. But in any case, what's going on in silver? Well, in silver, you had 1,322 contracts of 5,000 ounce silver trying to hunt for it over in the UK, pulled off of COMEX. Why? Because there's not a lot of deliveries in April. You only have 84 deliveries yesterday and 171 contracts left. And you can't deliver on May yet because that doesn't happen until the last 2 business days of April to trade in May, where you can stand for delivery. So what are they going to do? They're going to use EFP and try to go get the physical over in the UK. Whether they're going to be able to do that or not, is anybody's guess. That's an unallocated market. We'll see if they have the gold or if they can get it. The day before, on Friday, we had EFPs at 901. And overall, not a lot of deliveries, 2 deliveries. So that goes to show you this is not a heavy delivered market. People are going elsewhere for delivery or exposure to higher prices because the price is suppressed here. I'm going to show you that on the COT report here in a moment. Looking at the settlement data, you can see as of yesterday, silver was up almost 31 cents on the dominant contract, which right now is May because they have 131,000 contracts traded, although that's slowly rotating into July as well. July will probably be the next big delivery month, or maybe further down as people rotate. And again, about 6 months in silver or heavier traded, and therefore have the opportunity for heavier physical deliveries, even though on average, less than 0.1% of all contracts are actually delivered on the COMEX because it's not a huge delivery market like the Chinese Shanghai is. Going over to settlements, Friday's data up 26%. We did Mondays already, and Thursdays up 18.7. The only reason I show that to you is to know where spot prices are determined, and it ain't at your local coin dealer or on this exchange because it's not where the physical deliveries occur. On to silver COT report, commitment of traders. The first thing I will show you is percent of open interest, long and short. You can see here that there is a concentrated short position in silver. 28.4% belongs to the top 4 traders, 44.9, almost a half, all shorts to the top 8. That does include basically the swap dealers, which are the banks, and some of the producer merchant category, although most of them are banks. This column is legitimate hedging. This is where the shorting occurs to keep the price down, and the managed money and other reportables do what they're going to do, and they usually trade against the swap dealers. That's basically how the market works most of the time. Other reportables being family offices, wealthy individuals, small companies, that kind of thing. People that have some size that can get on the market, but they're not the big super banks or the producers or people like Samsung, the big companies that are using the metal. They're basically there for speculation or they may hold some physical interest that they're trying to protect with insurance on the market, because this market's like an insurance market in a way, or a hedge market, but most part it's speculation. Well, we always look at the swap dealers because they have the highest amount of short positioning without being a producer or a merchant that's actually going to use the physical metal. So that's why that's important. And that's why these guys, swap dealers, with all these shorts, 56,000, belong in this concentrated short position down here. That's who they are. And the OCC report, the Office of Comptroller of the Currency Derivative Report, indicates who the big four banks are. We know who they are. And they've been the same actors here for a long time. Well, they did subtract 33 shorts and subtract 302 longs. So they were basically neutral through April 2nd. Now, the one thing to point out, if you're new to the channel, the Commitment of Traders report's about a week old. It's the 9th, and this came out the 2nd, or through the 2nd. It came out Friday, but it's through the 2nd because the CFTC compiles this data after the fact. They get it from the traders and the exchanges. So it's late, but it shows you that they were fairly neutral on silver for that week. And so they weren't shorting a lot, they weren't going long, and that did give room for silver to kind of the price to rise, but they were shorting gold. So this is gold. Okay, same thing down here in concentrated positions. Top 4 traders, 5.9% short. Top 8, 51.8. Same banks up here. Same setup with legitimate hedging here under producer merchants. This is basically the big short. The managed money and the other reportables are more the speculators in the market going for upside price, typically going for upside prices, why they tend to be more long than short. The banks added almost 10,000 short gold contracts trying to control gold's price to the downside. I say trying to control because legitimate hedging happens on the left side of the chart, producer merchants. The banks don't need to do a ton of that. They do have clients that may be producers or merchants, but they're not the majority because so many ounces are covering these contracts. You don't need like hedging beyond the actual physical production in the next 2 to 3 months. It doesn't make sense. So a lot of this is short interest speculation, keeping the price down, and they make money doing it. We've explained that in previous videos. It's a long explanation, but they make money on both sides of the market, but they also try to control or suppress the price. That's why the price is higher in Shanghai. That's why the EFPs are trying to go get exposure in London, because the prices are different. The COMEX is the big short around the world. That's essentially what it is. It's the big shorting market. So the banks do their damage. They added 9,788 shorts through April 2nd, trying to basically stop the gold price from rising, or maybe that's not the right way to put it, because they believe it should go down, and they're going to put contracts in the market to edify that position or try to move it in that position. That's why they do so many at one time throughout that week, but that's basically what happened. So you know where the shorts are coming from, but the key thing, it's not stopping things. You know, the Chinese are in there buying tons of gold. The Indians are in there from India, not Native Americans here, but from India, buying tons of silver. The market around the world is starting to go in a little bit of economic chaos. Where are they turning to? The metals. What's that doing to the prices? Rising them. And even though you have the bullion banks here in the US basically shorting the hell out of it, because this is the big short market, as I just pointed out, it's not stopping it. So it's around the world. If you get enough concentrated buying power around the world, you can break that price suppression scheme. Now, can you fully break it? Or the bank's going to come back and just keep doing what they do and try to control it? A lot of that has to do the intersection of demand for the physical slowing down and the ability of the banks to put more short paper on the market to control it. We'll see, you know, what happens as we go forward. But we've got a nice little rally in gold and silver. It's great. I think silver's up over 28 bucks this morning. Who knows what it'll be by the time you see the video. But it was up, and let's just read out the prices for you since we're here at the moment, according to the Kitco app. Gold's up 11.70 on the day to 23.50.10. And silver's up 24 cents to 28.16. Good prices. Now, in silver, one of the key resistance points is 26 bucks. We're past that, going to 30. 30 is the next really big resistance point. Now, there's a couple between 26 and 30, 27.50, 28 in that range, 28.50. But 30 is the big bad boy. So I don't know if we're going to eclipse 30 this time, but silver went from about 22 to about 28 in just a span of a few weeks, since about mid-March. Now, if you'll remember on my program, I did an analysis of the silver market. One of my subs sent me an Elliott wave analysis, which is a technical chart analysis of the silver market, and said it would break out about mid-March, and then it would have a short pullback and go back up. And that's exactly what happened. Now, the actual price numbers were slightly off, but that's normal. In charting, you don't worry about exact numbers. You're looking at direction and strength of direction and time frame of direction. And that Elliott wave analysis was right on the money for my subscribers. And we'll see if that continues. But it looks like the market broke out of resistance, of multi-year resistance, and it's running. We'll see how long that goes before we get a pullback. At some point, we'll get a pullback. All bull markets do. But I think we can officially say we're in the final leg of the big move of gold and silver up. It's going to go for a while. It could go for potentially months and months and years, because we haven't really got to the worst part of the economic collapse yet. We haven't gotten to the currency collapse, the debt collapse, all that kind of stuff that we talk about all the time. So we got a lot of room to run, but just expect that we'll probably have a pullback at some point in time. But it's also illustrative to know that when the world wants gold and silver, the Western banks can't necessarily stop it, at least using that derivative market. And it shows you that while the derivative market during times at which stocks and bonds tend to be doing okay, can sort of control or corral gold and silver prices and kind of keep it, the growth around CPI inflation numbers, especially in gold. When people want it in a crisis, they can't. They can't without putting themselves at risk by taking the short positions, because it could bankrupt them if they too many and they didn't have something to offset it. So that's something that we'll look and continue to follow as we go forward. Very interesting dynamics for those who've been stacking for a long time. Good for you guys. For those guys that came in a shop a few months ago and were slamming their silver down the table, it's never gonna rise, blah! And they were just so angry and everything. That's literally, one guy was like, I'm so angry, silver space, blah. Well, look at it now. Are you happy now that silver and gold are rising? So sometimes it just takes time. Just have faith and stick in there. You know the fundamentals. You know what people are going to value when the stuff hits the fan. The proverbial stuff hits the fan, right? Just don't give up. Don't quit. Don't be a weekend and quit. And I mean that with respect. Don't quit. Believe in yourself. Believe in your knowledge. Believe in the market. Believe in 5,000 years of history, and you shall be rewarded for that. Do your work, do your research, and don't just get frustrated and quit early. A lot of people will quit or capitulate or give up right before the good stuff happens. We're now getting into the good stuff stage. And yes, we'll have pullbacks along the way, but we're in the good stuff stage. So stick with it, man. Don't get angry at your local coin dealer or anybody that talks gold and silver or the TV, and don't liquidate your gold and silver before you get the benefit out of it. Just stick with the trade. Anyway, off my soapbox a little bit, but I think it was kind of humorous that people were so agitated. And I'm like, this is right before it goes up. Like, you don't quit now, and you may still not be in the money, especially if you bought really high premium gold and silver or silver eagles, but that's okay. Just stick with it, man. Trust me. We just getting started. So stick with it. Have a long-term view. Don't give up. Only sell it if you got to for cash. But if you're into gold and silver right now, and again, I'm not your financial advisor, don't trade off of this. Don't listen to me. Do your own research. Consult your financial advisor, your accountant, legal expert, all that stuff. That's my disclaimer. But look at what we're seeing in the market. If you believe, as I do, that gold and silver is going to continue to rise, because fundamentally the problems around the world, don't give up. Don't exit out just yet, man. Stick with it, man. If you're in, you're in, and sell it if you need to in an emergency, and again, consult your financial advisor about that. Don't listen to me. I'm just a YouTuber. Do your own research, but hey, we tend to be right more often than we're wrong. So at least the research is good. Thanks everybody for joining. Till next time, Rob Keents, Gold Silver Pros at www.goldsilverpros.com.